Let me take you back to a time and place that shaped one of the most remarkable minds in modern history. It's the 1930s, and we're in Omaha, Nebraska, a city sitting right in the heart of America during the Great Depression. The economy has collapsed, people are struggling, and most folks are just trying to figure out how to put food on the table. But in one particular household on Dundee Street, a young boy named Warren Buffett is thinking about something entirely different. He's about 6 or 7 years old, and already something sets him apart from the other children in his neighborhood. While they're playing tag or building forts out of sticks, Warren's mind is working on a different kind of puzzle. He's fascinated by numbers. Not in the way a child might be fascinated by a toy. This is something deeper, something that seems to come naturally to him, like breathing. His father, Howard Buffett, was a stockbroker and later a congressman. Howard wasn't wealthy by any stretch, but he had something more valuable to pass on to his son, a way of thinking about money that was honest and grounded. Howard believed that wealth came from understanding value, from making smart decisions, and from never taking unnecessary risks. He didn't believe in get-rich-quick schemes or gambling. He believed in earning, saving, and investing wisely. These weren't just ideas he talked about. They were how he lived his life, and young Warren absorbed them like a sponge absorbs water. Picture the scene: a boy sitting at the kitchen table watching his father read the stock pages of the newspaper. Most children would find this boring. Warren found it mesmerizing. He'd ask questions, endless questions, about why certain stocks went up and others went down. His father would explain patiently that stocks represented ownership in real businesses. A stock wasn't just a number on a page. It was a piece of something real, something that made things or provided services. This distinction mattered enormously, though young Warren didn't fully understand why yet. By the time he was 8 years old, Warren had already started his first business venture. He bought a 6-pack of Coca-Cola from his grandfather for 25 cents and sold each bottle for 5 cents to his neighbors. Let's think about what that means. He made a profit of 5 cents per bottle, which meant 30 cents total on his initial investment of 25 cents. That's a 20% return on his money. Most adults wouldn't think much about this. It's a small transaction, a child's game. But Warren understood something crucial that most people never grasp, even as adults. He thought to himself, I gave up something I had the money, and in exchange, I received something more valuable. The money came back to me plus extra. This wasn't luck. It wasn't magic. It was a simple transaction where both sides benefited. The neighbors got their Coca-Cola. Warren got his profit. And in that moment, something clicked in his young mind about how the world actually worked. His next venture involved chewing gum. He'd buy it in bulk and sell it individually to other kids at school. Again, the same principle applied. Buy low, sell higher, keep the difference. But here's where Warren's mind was already different from most children's. He wasn't just thinking about making a quick nickel. He was beginning to understand the concept of volume and efficiency. If he could sell more gum, he could make more profit. If he could find a cheaper source, he could increase his margin. These weren't conscious business strategies, yet he was just a kid, but the seeds were being planted. The Depression created a particular kind of atmosphere in Omaha during those years. Money was tight. People were careful. Waste was shameful. In this environment, Warren's natural inclinations were reinforced by the culture around him. Saving money wasn't just smart. It was necessary. Understanding value wasn't a luxury. It was survival. His mother, Layla, came from a wealthy family, but even that background emphasized responsibility and careful stewardship of resources. Warren grew up in a household where money was respected but not worshipped. It was a tool, a means to an end, not an end in itself. What made Warren different wasn't just that he liked making money. Plenty of kids have entrepreneurial impulses. What set him apart was his hunger to understand how money actually worked. He didn't just want to make a nickel. He wanted to know why the nickel mattered, how it could grow, what it could become. He wanted to understand the mechanics beneath the surface. By the time he was 10 years old, Warren had saved enough money from his various ventures to buy his first stock. It was Citi's Service Preferred Stock, and he bought it at $38 per share. The stock dropped to $27 shortly after his purchase. For most people, this would be a crushing disappointment. For Warren, it was a lesson. He'd learned that markets could be irrational. Prices could fall even if the underlying business remained sound. This understanding that price and value were different things would become the cornerstone of his entire investment philosophy decades later. But at that moment, he was just a boy in Omaha watching his first investment decline in value and learning one of the most important lessons of his life. The stock eventually recovered and climbed to $40, and Warren made his first profit on the stock market. He'd turned $38 into $40. It doesn't sound like much, but to him, it meant everything. It confirmed what he'd been beginning to understand. If you paid attention, if you thought carefully, if you were patient, money could grow. This was the beginning. A curious boy with an unusual mind, living in a city struggling through the Depression, surrounded by people who valued hard work and careful thinking. The pieces were falling into place, though no one could have known then that this child would one day become one of the wealthiest and most influential investors in human history. For now, he was simply a boy with different eyes that saw value, where others saw only numbers and possibilities, where others saw only obstacles. When Warren turned 13, he took on a newspaper route, delivering the Washington Post in his neighborhood. This wasn't just another small business venture. It became the crucible where his understanding of money transformed from theory into lived experience. He'd wake up early, collect his papers, and deliver them to hundreds of customers throughout Omaha. The work itself was unglamorous. His fingers got cold in winter. His legs grew tired from walking. But what mattered to him happened in the margins of this job. Every morning he calculated his earnings. He tracked his expenses, the cost of the papers, his delivery time, the wear on his shoes. He understood that profit wasn't simply money that came in. It was money that came in minus money that went out. This distinction, obvious to an accountant, felt revelatory to a teenager. He could see the direct relationship between his effort, his efficiency, and his earnings. If he delivered more papers, he made more money. If he found ways to deliver faster, he saved time that he could use for other ventures. The newspaper route taught him something that school never could, the concrete reality of how value gets created and captured. During these years, Warren also discovered the Sears catalog. To modern readers, this might seem like an odd detail, but the Sears catalog in the 1940s represented something profound. It showed him that a business could operate on a massive scale by understanding what customers wanted and delivering it efficiently. Sears didn't just sell products, it had created a system. Customers could browse at home order, by mail, and receive goods delivered to their door. The company had solved a problem that millions of people faced: how to access quality merchandise without traveling to a city. Warren studied how Sears operated. He read about its founder, Richard Warren Sears, and its president, Julius Rosenwald. He wanted to understand not just what these companies did, but how they thought about their business. Around this same time, Warren encountered his first real mentor, a man named Fred Cuny, who ran a local investment club, took an interest in the ambitious teenager. Kuna didn't just tell Warren about investing, he showed him how successful investors thought about opportunities. He introduced Warren to the idea that you could study a business, understand its economics, and make informed decisions about whether to own a piece of it. This mentorship planted seeds that would grow for decades. Warren realized that investing wasn't gambling, despite what many people believed. It required study discipline and rational thinking. His reading during these teenage years became voracious. He devoured books about business economics and investing. He read Dale Carnegie's How to Win Friends and Influence People, which taught him about human nature and persuasion. But the book that truly changed his trajectory came when he was about 15 years old. He discovered Benjamin Graham's The Intelligent Investor. Graham's ideas struck Warren like lightning. Here was a man who'd lived through the stock market crash of 1929 and the subsequent depression. He'd seen investors lose everything because they didn't understand what they were buying. Graham proposed something radical, that an investor should think like a businessman, not a speculator. You should only buy a stock if you'd be willing to buy the entire company at that price. You should demand a margin of safety, a significant discount between what you paid and what something was actually worth. You should focus on value, not on price movements or market trends. He thought to himself, this is it. This is how you actually build wealth. Not by gambling on price movements, not by following the crowd, but by understanding value and having the discipline to wait for opportunities where the price is significantly lower than the value. Graham's philosophy resonated with everything Warren had learned from his father and from his own business experiences. It gave him a framework, a way to think about money that felt true. During his teenage years, Warren also ventured into the pinball machine business. He and a friend purchased a used pinball machine and placed it in a local barber shop, splitting up the profits with the owner. This business taught him about passive income money that came in without him having to actively work for it every single day. The machine would sit in the barber shop, customers would play it, and coins would accumulate. He and his friend would collect the money periodically. It wasn't much, but it represented a different kind of earning than his newspaper route. He could see the power of having something work for you rather than working yourself. By his mid-teens, Warren had begun to notice something about himself that set him apart from his peers. While other boys his age were thinking about sports dating and social status, he was thinking about compound returns and business economics. He didn't feel lonely about this difference. He felt energized by it. He understood that most people didn't think this way, and that gave him an advantage. His classmates might have had more natural athletic ability or social charm, but they didn't have this hunger to understand how money and business actually worked. This realization created a kind of quiet confidence in him. He knew he was on a different path. He didn't need to be the most popular kid in school or the best athlete. He had something else, a direction, a purpose, a framework for thinking about the world. While other teenagers were figuring out who they were, Warren had already begun to figure out what he wanted to become. The teenage years solidified something essential in his character: patience combined with action. He wasn't waiting passively for wealth to come to him. He was actively working, learning, and investing. But he wasn't in a hurry. He understood that building real wealth took time. The newspaper wrote the pinball machine, the stock purchases. These weren't get-rich-quick schemes. They were the foundation of a philosophy that would guide him for the rest of his life. By the time he graduated from high school, Warren Buffett had already lived more business education than most people would accumulate in a lifetime. Warren Buffett arrived at the University of Pennsylvania in 1947, a 19-year-old with a clear sense of purpose that most college students didn't possess. He'd already made his first stock purchases. He'd already run multiple businesses. He'd already read Graham's The Intelligent Investor and felt the intellectual jolt of discovering a coherent philosophy about how to build wealth. But he knew something crucial. He needed to study under the man who'd written that book. After 2 years at Penn, he transferred to Columbia University, specifically to attend Benjamin Graham's classes. Graham by this time had become a legend in investing circles. He'd survived the crash of 1929, built a successful investment firm, and written the book that would eventually become the Bible for serious investors. But Graham wasn't just a successful businessman. He was a teacher, a philosopher, someone who believed that investing could be taught and learned through rational analysis. When Warren walked into his classroom, he encountered something rare, a mentor who could articulate the principles that had been forming in his own mind. Graham's approach to investing rested on a simple but powerful idea. The market price of a stock and its intrinsic value were often different things. The market, driven by fear and greed, frequently priced stocks either far too high or far too low. A disciplined investor could study a business, calculate what it was actually worth, and then wait for moments when the market price fell significantly below that value. When that happened, you bought. When the price rose back to fair value or higher, you sold. This wasn't speculation. It wasn't gambling. It required homework, patience, and emotional discipline. The contrast between this approach and what most investors did couldn't have been starker. In the 1940s, many people treated the stock market like a casino. They bought stocks based on tips from friends, or because they'd heard a company was going to do well, or simply because prices were rising. They bought high and sold low, driven by the herd mentality that Graham called Mr. Market. Graham personified the market as a moody, irrational character who'd offer you prices every day, sometimes ridiculously high and sometimes ridiculously low. A smart investor would take advantage of Mr. Market's mood swings without being influenced by them. He thought to himself, "This is exactly what I've been trying to understand. Graham has given me the language and the framework for what I've been learning through experience." Warren realized that his newspaper route, his pinball machine business, his early stock purchases, all of these had been teaching him the same lessons that Graham articulated in the classroom. But now he had a comprehensive philosophy, a way to think systematically about investment decisions. During his time at Columbia, Warren didn't just attend Graham's classes. He studied Graham's investment letters, analyzed the stocks that Graham's firm owned, and tried to understand the reasoning behind each decision. He'd read Graham's analysis of a company and then do his own research to see if he agreed with the conclusions. This wasn't passive learning. Warren was actively engaging with Graham's ideas, testing them, and building his own understanding. What struck Warren most profoundly was Graham's emphasis on margin of safety. This principle suggested that you should never pay full value for an investment. You should demand a discount, a cushion of safety that protected you if your analysis proved wrong or if circumstances changed. If a business might be worth $100, you'd only buy it if the price dropped to $60 or $70. This margin of safety meant that even if you made mistakes in your analysis, you'd still likely make money over time. The intellectual awakening that occurred during this period went beyond just learning investment techniques. Warren encountered a way of thinking about the world that felt fundamentally true. Graham didn't promise quick riches. He didn't claim to know what the market would do tomorrow or next month. Instead, he offered something more valuable, a method for thinking clearly about complex decisions in the face of uncertainty. He taught that success in investing required the same qualities that success in any field required: discipline, rationality, continuous learning, and the ability to resist emotional impulses. After graduating from Columbia, Warren wanted to work directly for Graham. He applied to Graham's investment firm, Newman Graham, and was hired. For 2 years, he worked as an analyst, studying companies' writing reports and learning from Graham's decision-making process. He watched how Graham approached difficult choices. He saw how Graham could look at a business that everyone else dismissed and recognize hidden value. He learned that patience often provided the greatest advantage, that being willing to wait for the right opportunity. Sometimes for years, separated successful investors from unsuccessful ones. During this apprenticeship, Warren absorbed more than just investment principles. He learned how to think independently while respecting the wisdom of others. Graham encouraged his analysts to challenge his ideas, to think critically, and to form their own conclusions. This created an environment where learning accelerated. Warren could test his thinking against Graham's experience and the experience of other talented investors in the firm. The emotional resonance of finding his life's work cannot be overstated. For most people, choosing a career involves some uncertainty. You try different things, see what fits, and gradually build a life around your strengths and dead interests. Warren's experience differed fundamentally. By his early 20s, he'd already identified the field where he wanted to spend his life. He'd found a mentor who could teach him the principles he needed to master. He discovered that his natural inclinations, his love of numbers, his patience, his hunger to understand how things worked, aligned perfectly with the demands of intelligent investing. When Warren eventually left Graham's firm and returned to Omaha, he carried with him not just knowledge, but a complete philosophy. He understood that building wealth required thinking differently from the crowd, studying carefully before acting, and having the discipline to wait for genuine opportunities. He knew that success in investing, like success in life, required patience combined with action knowledge, combined with humility and confidence, combined with caution. Graham had given him the intellectual framework. Now he would spend the rest of his life applying it. When Warren returned to Omaha in 1954 at age 24, he carried with him Benjamin Graham's philosophy, but faced a practical question. How would he apply these principles to build his own wealth? He took a job at his father's brokerage firm, but his mind kept returning to the idea of starting his own investment partnership. He'd learned from Graham that you didn't need enormous amounts of capital to begin. You needed discipline and good judgment and the ability to convince others that your approach worked. In 1956, Warren launched Buffett Partnership Ltd. with 7 limited partners who invested a combined $100,000. Warren himself contributed just $100, but he committed his time and his intellect. The structure was straightforward. Investors would give him money to manage. He would make investment decisions, and they would split the profits according to their ownership stakes. This arrangement aligned his interests perfectly with those of his investors. He only made money if they made money. He had every incentive to think carefully about each decision. The partnership's early years produced solid returns, but nothing spectacular. Warren invested in stocks that he believed traded below their intrinsic value. He'd study annual reports, analyze balance sheets, and calculate what he thought a business was actually worth. When he found a significant discount between market price and intrinsic value, he'd buy. He didn't chase hot stocks or follow market trends. He simply executed the Graham philosophy with discipline and patience. Then in 1962, something caught his attention. Berkshire Hathaway was a struggling textile mill in New Bedford, Massachusetts. The company had once been profitable, but like many New England textile manufacturers, it had fallen on hard times. Competition from southern mills and international manufacturers had eroded its market position. The stock traded at around $7 per share, and the company's book value, the value of its assets minus its liabilities, stood at around $20 per share. Here was a classic Graham situation. The market had priced the stock far below its asset value. Warren began buying Berkshire stock through his partnership. He wasn't buying it because he believed the textile business would suddenly become profitable again. He was buying it because the assets had value, and if those assets could be deployed more efficiently, the stock could be worth significantly more than $7. He accumulated shares gradually, and by 1965, his partnership owned enough stock that Warren could gain control of the company. He thought to himself, "The textile business is dying, but the company has cash, it has real estate, and it has the potential to become something different. If I can take control and redirect these assets toward more profitable ventures, this could become valuable." This decision represented a crucial shift in his thinking. He wasn't just going to be a passive investor buying undervalued stocks. He was going to take active control of companies and reshape them. The early years of transforming Berkshire Hathaway from 1965 to 1970 required difficult decisions. Warren gradually wound down the textile operations. He kept the cash that the business generated and the insurance subsidiary that Berkshire had acquired. He began looking for better uses for the company's capital. This period taught him something essential. Sometimes the best investment decision involves stopping an activity that no longer makes sense, even if that activity had defined the company for decades. Building a team and culture became increasingly important as Berkshire grew. Warren couldn't personally analyze every investment opportunity or manage every aspect of the business. He needed people who shared his philosophy and could make good decisions independently. He hired Charlie Munger, a lawyer and investor who'd become a close friend and intellectual partner. Munger brought a different perspective to investment decisions, and the two men's collaboration would eventually become legendary in investing circles. Warren made mistakes during these early years, and he learned from them. He invested in textile machinery companies thinking he could improve their profitability through better management. The investments underperformed. He bought into the insurance business, somewhat haphazardly, not fully understanding its economics at first. Over time, he developed a much deeper understanding of insurance, but initially, he'd moved faster than his knowledge justified. These mistakes taught him the importance of staying within his circle of competence, investing only in businesses he truly understood. The patience principle that Graham had emphasized became increasingly central to Warren's approach. While other investors constantly traded buying and selling stocks based on short-term price movements, Warren would sometimes hold a position for years, waiting for the right moment to act. He'd accumulate shares of companies gradually, sometimes over months or years. He'd wait for market downturns to deploy capital. This patience required emotional discipline. It meant watching other investors make quick profits and resisting the urge to imitate them. It meant believing in your analysis, even when the market disagreed. The weight of responsibility grew heavier as the partnership's assets increased. By the late 1960s, Warren was managing millions of dollars for hundreds of investors. Every decision he made affected real people's financial futures. He took this responsibility seriously. He wouldn't invest in something he didn't understand just because it might be profitable. He wouldn't take unnecessary risks with other people's money. This sense of stewardship shaped every choice he made. During this period, Warren also began writing letters to his partnership investors. These letters explained his investment philosophy, discussed the returns the partnership had achieved, and reflected on lessons learned. The letters became increasingly thoughtful and detailed over time. Warren used them not just to report results, but to educate his investors about how he thought about investing. These letters would eventually become famous in investing circles, studied by professionals and amateurs alike. By 1970, Berkshire Hathaway had transformed from a failing textile mill into an investment company with significant assets and growing profitability. The stock that had traded at $7 per share in 1962 now traded at much higher prices. Warren's partnership had generated returns that significantly exceeded the stock market average. He'd proven that Graham's philosophy could work not just in theory, but in practice over an extended period. The foundation had been laid. Warren had demonstrated that he could identify undervalued companies, take control of them, and create value through intelligent capital allocation. He'd built a team and a culture that valued rational thinking and long-term results over short-term gains. He'd learned from mistakes and refined his approach. Most importantly, he'd proven something to himself and to his investors that patience, discipline, and clear thinking could generate extraordinary wealth over time. The exponential growth that would follow in the coming decades would build on this foundation. By his 30s, Warren Buffett had moved beyond simply applying Graham's principles. He'd begun to develop his own philosophy, refined through years of real-world experience. The most important concept that emerged during this period was the idea of the circle of competence. This principle sounds simple, but its implications run deep. It means understanding clearly what you know well and what you don't know, and restricting your investments to areas where you possess genuine expertise. Most investors struggle with this discipline. They see an opportunity that looks profitable, and they convince themselves they understand it well enough to invest. They buy stocks in industries they've never studied. They make decisions based on tips from friends or articles in magazines. They chase trends without understanding the underlying businesses. Warren refused to do this. He'd learned from his mistakes in textile machinery and from watching others lose money in ventures they didn't understand. He developed a rigorous standard. He would only invest in businesses whose economics he could grasp clearly. This didn't mean he had to understand every detail of how a business operated. It meant he had to understand the fundamental economics. What made the business profitable? What advantages did it have over competitors? What could threaten those advantages? Could he predict with reasonable confidence how the business would perform over the next decade? If he couldn't answer these questions satisfactorily, he'd pass on the opportunity no matter how attractive it appeared. In 1972, Warren encountered See's Candies, a California-based chocolate manufacturer. The company had been family-owned for decades and produced high-quality candies that customers loved. See's didn't advertise much. It didn't have the lowest prices. Yet customers returned repeatedly, willing to pay premium prices for the product. Warren paid $25 million for the company, a price that many investors thought excessive. But he understood something crucial about See's economics. He thought to himself, this business has a moat around it. Customers don't choose See's because of price or because of advertising. They choose it because they love the product and trust the brand. That loyalty is worth real money. If I raise prices slightly, customers will still buy. The business generates enormous amounts of cash relative to the capital required to run it. This is exactly the kind of business Graham taught me to look for. See's Candies became one of his most successful investments, not because the company grew dramatically, but because it generated consistent, predictable profits that could be reinvested in other opportunities. The seized investment taught Warren something about competitive advantage that would shape his thinking for decades. He began to focus on what he called economic moats, durable competitive advantages that protected a business from competition. A moat could come from brand loyalty like See's. It could come from network effects where the business became more valuable as more people used it. It could come from switching costs where customers found it expensive or inconvenient to switch to competitors. It could come from cost advantages that allowed a company to undercut competitors while remaining profitable. During this same period, Warren deepened his understanding of the insurance business. Insurance companies collect premiums from customers and invest that money before paying out claims. The period between collecting money and paying it out is called the float. Warren realized that float represented essentially free capital that an insurance company could invest. If an insurance company collected $100 million in premiums and didn't have to pay out claims for several years, it could invest that $100 million and keep the returns. This insight transformed how he thought about insurance companies. He acquired National Indemnity Company, and later GEICO, recognizing that excellent insurance companies with strong competitive advantages could generate enormous amounts of float that could be deployed in other investments. This understanding of float would eventually provide Berkshire with billions of dollars in capital to invest. But it required thinking differently from most investors. Most people saw insurance as a commodity business with thin profit margins. Warren saw it as a source of cheap capital for investment. Learning to think long-term in a short-term world required constant discipline. The stock market rewarded companies that met quarterly earnings targets. Analysts focused on next quarter's results. Investors traded stocks based on daily price movements. Warren ignored all of this noise. He thought in terms of decades. When he bought a stock or acquired a company, he asked himself, will this business be worth significantly more in 10 or 20 years? If the answer wasn't clearly yes, he wouldn't buy it regardless of what the market was doing in the short term. This long-term perspective allowed him to see the power of compounding more clearly than most investors. Albert Einstein supposedly called compound interest the eighth wonder of the world. The math is straightforward. If you earn 10% annually on $100, you have $110 after 1 year. If you earn 10% on that $110, you have $121. The growth accelerates over time. After 10 years, you'd have roughly $259. After 30 years, you'd have over $1,700. The longer the time period, the more dramatic the effect. But compounding required two things: consistent returns and time. You couldn't achieve significant compounding if you lost money some years and made it back other years. You needed steady, reliable returns year after year. You also needed patience. The power of compounding only became apparent over long periods. This understanding shaped every investment decision Warren made. He'd rather earn 10% reliably for 30 years than earn 30% for 1 year and then lose it all. Emotional intelligence became increasingly important as Warren's responsibilities grew. He needed to understand not just the economics of businesses, but the psychology of the people who ran them. He'd study management teams carefully, looking for people who were honest, competent, and aligned with shareholders' interests. He'd avoid companies run by people who seemed primarily motivated by personal enrichment or who couldn't admit mistakes. He understood that a great business run by mediocre management would underperform while a good business run by excellent management could exceed expectations. The partnership letters that Warren wrote to his investors evolved during this period into something more than financial reports. They became essays on investing philosophy, reflections on business and human nature, and honest assessments of both successes and failures. Warren used these letters to educate his investors about how he thought, why he made certain decisions, and what he'd learned from experience. The letters became increasingly candid. He'd discuss investments that hadn't worked out. He'd explain his mistakes. He'd share his thinking about market conditions and investment opportunities. By the late 1970s, Warren had developed a comprehensive investment philosophy that integrated Graham's principles with his own insights. He understood the importance of margin of safety, the power of compounding the value of competitive advantages, and the necessity of staying within his circle of competence. He'd built a track record that demonstrated these principles worked in practice. The partnership had generated returns that dramatically exceeded the stock market average. Success, however, brought new challenges. The partnership had grown so large that it became difficult to find investments large enough to meaningfully move the needle. Warren would need to think differently about how to deploy capital at this scale. In 1983, when Warren Buffett turned 53 years old, Berkshire Hathaway stood at a crossroads. The company had evolved dramatically from its origins as a textile mill. The textile operations had been completely phased out. Insurance subsidiaries generated steady cash flow. The investment portfolio contained stakes in various companies. But Berkshire hadn't yet become the powerhouse it would eventually become. That transformation accelerated dramatically during Warren's 50s. The acquisition of Nebraska Furniture Mart in 1983 marked a turning point. The company's founder, Rose Blumkin, had built a furniture business through relentless focus on customer service and low prices. She was in her 90s when Warren approached her about selling. He offered her a price based on a handshake and a brief conversation. No lengthy due diligence. No armies of lawyers and accountants. Just two people who understood business, making a deal they both believed in. The acquisition demonstrated Warren's confidence in his ability to evaluate businesses and people quickly, but the real transformation came through the insurance business. GEICO, which Warren had invested in years earlier, became increasingly important to Berkshire's strategy. GEICO had figured out how to sell auto insurance directly to customers, bypassing the traditional agent system. This gave GEICO a significant cost advantage over competitors. The company generated enormous amounts of float that could be invested. Warren gradually increased Berkshire's stake in GEICO until Berkshire owned it entirely. The float from GEICO and other insurance subsidiaries eventually provided billions of dollars that Warren could deploy in new investments. He thought to himself, I now have access to capital that most investors can only dream about. But this brings responsibility. Every dollar I deploy needs to generate returns that exceed what we could earn by simply holding it in treasury bonds. The bar for investment decisions has risen dramatically. I can't afford to make mistakes at this scale. This realization shaped how he approached capital allocation during this period. Understanding competitive advantage became increasingly sophisticated during these years. Warren didn't just look for the companies with temporary advantages. He searched for businesses with durable, defensible, competitive positions that could persist for decades. He studied industries, carefully analyzing what made certain companies winners and others losers. He recognized that some industries had structural advantages that made them inherently more profitable than others. A railroad company, for instance, had enormous fixed costs and faced intense competition, making it difficult to earn high returns on capital. A company with a strong brand and customer loyalty, by contrast, could earn high returns for decades. The power of saying no became increasingly important as opportunities multiplied. Warren received constant pitches from investment bankers, entrepreneurs, and business owners who wanted Berkshire to invest in their ventures. Many of these opportunities looked attractive on the surface. They promised high returns or exposure to exciting new industries. Warren said no to almost all of them. He understood that discipline meant turning down 99 opportunities so he could focus on the one that truly fit his criteria. This discipline extended to Berkshire's internal operations. Warren resisted the temptation to diversify into new industries just because they seemed promising. He didn't chase technology stocks during the dot-com boom, even as the valuations became absurd and everyone around him seemed to be making fortunes. He didn't invest in businesses he didn't understand, no matter how much money others were making. This refusal to follow the crowd sometimes made him look foolish in the short term. Over longer periods, it proved to be one of his greatest strengths. Building a culture that would last required attention to people and systems. Warren recognized that Berkshire's success depended on attracting and retaining excellent managers. He created a compensation structure that aligned managers' interests with shareholders' interests. He gave subsidiary managers significant autonomy, trusting them to run their businesses well. He promoted from within when possible and developed deep relationships with the people who ran Berkshire's various operations. This approach created loyalty and continuity that many large corporations struggled to achieve. The annual shareholder letters evolved into something remarkable during this period. What had started as straightforward financial reports had become widely read essays on investing, business, and life. Warren wrote candidly about Berkshire's performance, explaining both successes and failures. He discussed his investment philosophy in accessible language that educated readers about how to think about investing. He reflected on broader economic and social trends. The letters became so popular that investment professionals and students studied them, carefully treating them almost like sacred texts. The emotional weight of managing billions of dollars became more apparent as Berkshire's scale increased. Warren understood that his decisions affected not just his own wealth, but the financial security of thousands of employees and hundreds of thousands of shareholders. When he decided to acquire a company, he was responsible for the livelihoods of its employees. When he made an investment decision, he was deploying capital that belonged partly to people who'd entrusted him with their life savings. This responsibility sometimes kept him awake at night. He took it seriously in a way that many investors didn't. The partnership with Charlie Munger deepened during this period and became increasingly central to Berkshire's success. Munger brought a different perspective to investment decisions. Where Warren sometimes focused on quantitative analysis, Munger emphasized qualitative factors and psychology. Munger pushed Warren to think about competitive advantages more deeply and to focus on quality businesses even if they cost more to acquire. The two men challenged each other's thinking, and this intellectual friction produced better decisions than either would have made alone. Munger also brought something else valuable. He could say no to Warren. As Berkshire grew and Warren's track record became legendary, few people felt comfortable disagreeing with him. Munger did. He'd challenge Warren's ideas, sometimes harshly if he thought Warren was wrong. This willingness to disagree, combined with genuine respect and affection, made their partnership extraordinarily productive. Munger's influence pushed Berkshire toward higher quality businesses and away from some of the more speculative investments Warren might have pursued. By the end of Warren's 50s, Berkshire Hathaway had transformed into something unprecedented. It wasn't a traditional insurance company, though it owned insurance subsidiaries. It wasn't a traditional investment company, though it invested in stocks and bonds. It wasn't a traditional holding company, though it owned dozens of operating businesses. It was something unique, a company structured to generate enormous amounts of capital that could be deployed in whatever opportunities made the most sense. The textile mill from New Bedford had become a global financial powerhouse. This transformation didn't happen through a grand master plan announced at the beginning. It happened through consistent application of principles, through learning from experience, through saying no to most opportunities, and saying yes to the few that truly fit. Warren had evolved from a brilliant investor managing a partnership into something more, the architect of a system designed to generate and deploy capital wisely for decades to come. The foundation had been built. Now the structure would grow beyond anything he'd initially imagined. By the time Warren Buffett reached his 60s, he'd articulated a set of core principles that had guided every significant decision throughout his career. These weren't abstract theories developed in isolation. They emerged from decades of real-world experience, from successes and failures, from studying businesses and human nature. Understanding these principles provides insight into how someone could build one of the world's greatest fortunes while maintaining remarkable consistency in approach. The first principle was deceptively simple: buy quality, not quantity. This meant focusing on owning pieces of genuinely excellent businesses rather than accumulating large numbers of mediocre ones. Most investors spread their capital across many holdings, believing that diversification protected them from losses. Warren took a different approach. He'd rather own a small number of exceptional businesses than a large number of ordinary ones. Quality businesses with strong competitive advantages, excellent management, and predictable earnings could generate superior returns over time. Mediocre businesses, no matter how many you owned, would produce mediocre results. See's Candies exemplified this principle. The company wasn't growing rapidly. It wasn't entering new markets aggressively. But it generated enormous profits relative to the capital required to run it. Customers loved the product and paid premium prices. The business required minimal capital investment to maintain its position. Warren would rather own all of See's than own pieces of dozens of candy companies struggling with competition and thin margins. The second principle involved thinking like an owner rather than a trader. Most stock investors thought like traders. They bought stocks hoping the price would rise so they could sell at a profit. They monitored prices, constantly looking for opportunities to buy low and sell high. They'd hold a stock for months or years, then sell it to move on to the next opportunity. Warren thought differently. When he bought a stock, he asked himself, would I be willing to own this entire business at this price? If the answer wasn't yes, he wouldn't buy it. Once he owned it, he'd hold it indefinitely, as long as the business remained excellent and the price remained reasonable. This ownership mentality changed how he evaluated investments. Instead of asking whether the stock price might rise in the next few months, he asked whether the business would be significantly more valuable in 10 or 20 years. Instead of worrying about short-term price fluctuations, he focused on the underlying business economics. This approach required patience and emotional discipline, but it produced superior long-term results. The third principle was that patience itself represented a competitive advantage. Most investors couldn't wait. They needed to deploy capital quickly. They felt pressure to show results. They worried that missing an opportunity would cost them dearly. Warren had learned that waiting often paid better than acting. He'd wait months or years for the right opportunity. He'd accumulate positions gradually rather than buying all at once. He'd hold cash when he couldn't find investments that met his criteria, even if holding cash meant underperforming the market in the short term. This patience gave him an enormous advantage. When market panics occurred and prices plummeted, Warren had cash available to deploy. Other investors fully invested had to watch helplessly as prices fell. Warren could buy excellent businesses at significant discounts. This pattern repeated throughout his career. The investors who succeeded weren't necessarily the smartest or the most talented. They were often the most patient. The fourth principle required understanding what you're buying before you buy it. This sounds obvious, but most investors violated it constantly. They'd buy stocks based on tips from friends, or because they'd read a positive article, or because the price was rising. They didn't understand the business they were buying. Warren refused to invest in anything he didn't understand. This meant turning down many opportunities. It meant missing some profitable investments. But it also meant avoiding catastrophic losses that came from investing in businesses you didn't comprehend. He thought to himself, if I can't explain the business to someone else in simple terms, I don't understand it well enough to invest in it. If I can't predict with reasonable confidence whether the business will perform over the next decade, I should pass. The cost of missing an opportunity is small compared to the cost of making a bad investment. This discipline kept him out of industries that seemed exciting but whose economics he couldn't grasp. It kept him away from technology stocks during the dot-com bubble, even as others made fortunes. The fifth principle involved maintaining a margin of safety in all investments. Graham had taught this principle, and Warren had internalized it completely. A margin of safety meant never paying full value for an investment. You demanded a discount, a cushion of protection. If you calculated that a business was worth $100, you'd only buy it if the price dropped to $60 or $70. This margin of safety protected you if your analysis proved wrong or if circumstances changed unexpectedly. This principle required discipline because it meant passing on many investments that looked attractive. It meant waiting for better prices. It meant sometimes watching opportunities pass by because the price never fell to your target. But over time, this discipline paid enormous dividends. The investments you made with a margin of safety generated superior returns. The ones you made without it often disappointed. The sixth principle focused on the long term while ignoring short-term noise. The stock market generated constant noise, daily price fluctuations, quarterly earnings reports, analyst predictions, market commentary. Most investors paid attention to this noise and let it influence their decisions. Warren ignored it. He focused on whether the underlying businesses were becoming more valuable. He ignored whether the stock price rose or fell in any particular year. He thought in terms of decades. This long-term focus allowed him to see the power of compound interest more clearly than most investors. Compound interest wasn't just a mathematical concept. It was the engine that drove wealth creation. If you earned 10% annually on capital and reinvested the returns, the capital would double roughly every 7 years. After 30 years, your initial capital would grow roughly 17-fold. But this required consistency. You couldn't earn 10% one year and lose it all the next. You needed steady, reliable returns year after year for decades. The emotional wisdom required to execute these principles shouldn't be underestimated. It required detachment from short-term outcomes while remaining deeply committed to long-term success. When the market fell and everyone around you panicked, you needed to remain calm and rational. When the market rose and everyone around you celebrated, you needed to maintain perspective. You needed to care deeply about making good decisions while not caring about whether those decisions looked good in the short term. Real examples illustrated how these principles played out. When Warren bought Geico stock in the 1970s, the insurance industry was struggling. Most investors avoided insurance stocks. But Warren understood Geico's competitive advantages. He bought at a significant discount to intrinsic value. He held the stock for decades while Geico became increasingly valuable. The investment generated returns that exceeded most other investments by a factor of many times. When he acquired Nebraska Furniture, most analysts questioned the price. The furniture business seemed ordinary. But Warren understood Rose Blumkin's competitive advantages. Her obsessive focus on customer service and low prices had created customer loyalty that competitors couldn't easily replicate. The business generated cash that could be reinvested. Over time, the acquisition proved to be extraordinarily valuable. These principles weren't unique to Warren. Other investors understood them intellectually. What distinguished Warren was his ability to execute them consistently over decades, without deviation, regardless of market conditions or external pressures. He didn't follow these principles when they seemed convenient and abandon them when they seemed inconvenient. He followed them always. For anyone listening to this story, these principles offer something valuable. They suggest that building wealth doesn't require genius or luck or access to special information. It requires discipline, patience, rational thinking, and the ability to resist emotional impulses. It requires understanding what you're doing before you do it. It requires thinking long-term in a world obsessed with the short term. These principles apply not just to investing, but to building a successful career, developing valuable skills, or creating anything of lasting value. The specifics differ, but the underlying logic remains constant. As Warren Buffett moved into his 60s and 70s, something shifted in how he thought about money and success. He'd already accumulated more wealth than he could possibly spend in multiple lifetimes. Berkshire Hathaway had become one of the world's most valuable companies. He'd achieved every financial goal he'd set for himself decades earlier. Yet instead of resting on his accomplishments, he began asking deeper questions about what wealth actually meant and what he should do with it. The realization that wealth represented freedom rather than consumption came gradually. Warren had never been particularly interested in the trappings of wealth. He didn't own yachts or private jets. He lived in the same house in Omaha that he'd bought in 1958 for $31,500. He drove modest cars. He ate simple food, often from fast food restaurants. His lifestyle remained remarkably unchanged, even as his net worth climbed into the tens of billions of dollars. This simplicity wasn't born from deprivation or lack of desire. Warren simply didn't care much about material possessions. What he cared about was the freedom that wealth provided. He could pursue whatever interested him without worrying about money. He could invest in companies he believed in without considering whether they generate quick profits. He could take risks on ventures that might fail because failure wouldn't threaten his financial security. He could spend time on activities he found meaningful rather than activities that generated income. That freedom, the ability to direct his own life according to his values, represented the true value of wealth. This understanding transformed how he thought about accumulating more money. At a certain point, accumulating additional billions didn't increase his freedom. He already had more freedom than any person could use. Additional wealth became abstract, a number on a balance sheet, rather than something that improved his actual life. This realization created a tension. He'd spent his entire career focused on building wealth. Now he questioned whether continuing to accumulate wealth made sense. He thought to himself, I have more money than I could possibly need. My lifestyle won't change whether I have 50 billion or 100 billion. The question isn't how much more I can accumulate. The question is what I should do with what I have. How can I use this wealth in ways that create genuine value for others? How can I ensure that my life's work benefits people beyond myself? This internal dialogue led him toward a different relationship with money. Understanding that money functioned as a tool rather than a goal represented a crucial shift. Most people treat money as the ultimate goal. They work to accumulate it. They measure success by how much they have. They believe that more money will solve their problems and make them happy. Warren had learned through experience that this thinking was backwards. Money was useful only insofar as it allowed you to accomplish things you cared about. Beyond a certain point, additional money didn't improve your life. It just gave you larger numbers to manage. This perspective freed him from the endless pursuit of accumulation. He could focus on what actually mattered, making good decisions, building excellent businesses, helping talented people accomplish their goals, and eventually ensuring that his wealth benefited society. The shift from treating money as a goal to treating it as a tool changed everything about how he approached his remaining years. The power of reputation and trust became increasingly apparent as Warren reflected on his career. He'd built Berkshire Hathaway into a global institution, but the foundation of that institution wasn't buildings or equipment or even capital. It was trust. Investors trusted him to deploy their capital wisely. Business owners trusted him to acquire their companies and preserve their legacies. Employees trusted him to run their companies with integrity. This trust, built over decades through consistent behavior and honest dealing, represented his most valuable asset. Warren understood that reputation, once damaged, couldn't be easily repaired. He'd seen brilliant investors and business leaders destroy their legacies through dishonest dealings or poor judgment. He'd made it a point throughout his career to maintain absolute integrity. He kept his word. He admitted mistakes. He didn't misrepresent facts to make deals look better. He treated people fairly. This commitment to integrity had cost him money. Sometimes he'd turn down profitable opportunities because they didn't feel right, but it had built something far more valuable than the money he'd foregone. In 2010, Warren and his wife Melinda, along with Bill Gates, announced the Giving Pledge. The commitment asked billionaires to pledge that they'd give away at least half their wealth to charitable causes during their lifetimes or in their wills. Warren pledged to give away virtually all his wealth. He'd already been donating to the Bill and Melinda Gates Foundation, but the Giving Pledge represented a public commitment to ensure that his wealth would benefit society broadly. This decision reflected his philosophy about wealth and responsibility. He believed that people who'd accumulated great wealth had a responsibility to use that wealth for the greater good. He didn't believe in leaving enormous fortunes to his children. He believed in giving them enough to do anything they wanted, but not so much that they could do nothing they wanted. The bulk of his wealth should go toward addressing problems that affected humanity broadly. Disease, poverty, education, and other challenges that required resources to solve. Finding meaning beyond accumulation required confronting questions that most people avoided. What made a life meaningful? Was it the amount of money you accumulated? The size of your company? The number of people who knew your name? Warren had concluded that none of these things ultimately mattered. What mattered was whether you'd lived according to your values, whether you'd treated people well, whether you'd created value for others, whether you'd learned and grown throughout your life, whether you'd left the world better than you found it. The relationship between money and happiness occupied his thinking increasingly. Research suggested that beyond a certain income level, additional money didn't significantly increase happiness. People with enough to meet their needs and have some security reported similar happiness levels, whether they had $10 million or $100 million. The differences in happiness came from other factors: relationships, meaningful work, good health, the ability to help others, and the freedom to pursue activities you found engaging. Warren had experienced this truth directly. His life hadn't become dramatically happier as his wealth increased beyond the point where he could buy anything he wanted. What had increased was his sense of responsibility and his desire to use his wealth meaningfully. He found deep satisfaction in building excellent businesses and helping talented people accomplish their goals. He found satisfaction in learning and in the intellectual challenges that investing presented. He found satisfaction in his relationships with his wife, his children, and his close friends. These sources of meaning had nothing to do with how much money he had. Learning that the best investments were in people represented another crucial insight. Throughout his career, Warren had invested in stocks and bonds and businesses. But increasingly, he recognized that his most valuable investments were in people. He'd invested in Charlie Munger's partnership and friendship, and that investment had paid dividends far exceeding any financial return. He'd invested in talented managers who ran Berkshire's subsidiaries, and their capabilities had created enormous value. He'd invested in the education and development of people throughout his organization, and those investments had shaped the company's culture and success. The legacy question haunted him in his later years. What would remain after he was gone? His name would fade from memory eventually, as all names do. His wealth would be distributed to charitable causes. His companies would continue operating under new leadership. But what would truly endure, he believed the answer lay in the principles he'd articulated and the culture he'd built. If Berkshire Hathaway continued to operate according to the principles of rational thinking, long-term focus, and integrity, it could create value for generations. If other investors learned from his approach and applied these principles in their own lives, his influence would extend far beyond his lifetime. This perspective brought a kind of peace. He'd spent his life building something that would outlast him. He'd accumulated wealth not for personal consumption, but to deploy it toward meaningful purposes. He'd learned that true success wasn't measured in dollars, but in the impact you had on others and the legacy you left behind. The boy from Omaha who'd been fascinated by numbers and profit had evolved into a man who understood that the deepest satisfactions came from meaning, relationships, and contribution. This wisdom, earned through decades of experience and reflection, represented the true treasure of his life. Warren Buffett's life offers profound lessons that extend far beyond investing and finance. The principles that built his fortune apply equally to developing your career, building relationships, creating art, or pursuing any meaningful goal. Understanding these lessons requires looking past the specific context of stock markets and business acquisitions to grasp the underlying truths about how success actually happens. Patience emerges as perhaps the most underrated advantage in modern life. Our culture celebrates speed. We want instant results, quick profits, rapid advancement. Warren's career demonstrates that patience often produces superior outcomes. He'd hold investments for decades while others traded constantly. He'd wait years for the right opportunity rather than forcing decisions. This patience gave him advantages that faster-moving competitors couldn't match. In your own life, patience might mean spending years developing a skill before expecting to earn significant income from it. It might mean building relationships slowly rather than trying to network frantically. It might mean saving money consistently for years before making a major purchase or investment. The compound effect operates in all areas of life, not just finance. If you improve yourself by 1% daily, that compounds into dramatic transformation over years. If you read for 30 minutes daily, you'll consume dozens of books annually and accumulate knowledge that compounds. If you exercise consistently, your health improves exponentially rather than linearly. If you practice a skill regularly, your ability compounds. Warren understood that small advantages compounded over decades produce extraordinary results. This principle applies whether you're building wealth, developing expertise, or creating anything of value. Starting small while thinking long-term creates a powerful combination. Warren began with a newspaper route and a few dollars. He didn't wait until he had enormous capital to start investing. He began with what he had and grew from there. You don't need perfect conditions to begin. You need to start with what's available and think about where you want to be in 10 or 20 years. The gap between where you start and where you want to end up gets bridged through consistent effort over time. Continuous learning shaped Warren's entire career. He read voraciously. He studied businesses. He learned from mentors. He reflected on mistakes and extracted lessons from them. He remained intellectually curious throughout his life. This commitment to learning meant that his capabilities increased over time rather than plateauing. In your own journey, prioritizing learning, whether through reading a formal education, mentorship, or experience, compounds your capabilities and opportunities. Understanding your circle of competence prevents costly mistakes. You don't need to be excellent at everything. You need to be excellent at something and honest about what you don't know. Warren turned down countless opportunities because they fell outside his circle of competence. This discipline protected him from losses that came from investing in areas he didn't understand. In your career, this might mean focusing deeply on developing expertise in one area rather than spreading yourself thin across many areas. It means knowing what you're good at and what you're not, and being honest about those boundaries. Discipline and delayed gratification separate successful people from unsuccessful ones. Warren could have spent his wealth on luxury and consumption. Instead, he delayed gratification, reinvested his earnings, and built something larger. This discipline applied to his time as well as his money. He focused on activities that created long-term value rather than short-term pleasure. In your life, discipline might mean declining social invitations to study or work on a project. It might mean spending less than you earn so you can invest in your future. It might mean practicing when you'd rather relax. These small choices, repeated consistently, determine your trajectory. Building systems that work while you sleep represents a crucial concept. Warren didn't just trade stocks actively. He built systems, insurance companies, manufacturing operations, investment processes that generated value continuously. You can apply this principle by developing skills that create passive income, building businesses that don't require your constant attention, or creating content that continues to provide value long after you've created it. The goal isn't to work less, but to create leverage where your efforts produce returns that extend far beyond the time you invest. Success truly functions as a marathon rather than a sprint. Warren's wealth didn't accumulate dramatically in his first few years. It accelerated over decades as compounding took effect. His net worth in his 30s was modest compared to his net worth in his 60s and 70s. This pattern holds true across fields. Musicians typically spend years developing before achieving recognition. Entrepreneurs often struggle for years before their businesses succeed. Athletes train for years before reaching peak performance. Understanding that success takes time prevents discouragement when progress seems slow. Luck and preparation intersect in ways that determine outcomes. Warren benefited from luck being born in America, living during a period of economic growth, encountering mentors at crucial moments. But he'd also prepared himself through study and discipline so that when opportunities arose, he could recognize and capitalize on them. You can't control luck, but you can control preparation. By developing skills, maintaining knowledge, and building relationships, you position yourself to benefit when luck appears. Thinking like an investor in your own life means evaluating decisions based on long-term returns rather than short-term costs. Should you invest time in learning a difficult skill? The short-term cost is high the time and effort required. The long-term return might be enormous decades of enhanced capability and an opportunity. Should you invest in your health through exercise and good nutrition? The short-term cost is discipline and effort. The long-term return is better health and energy throughout your life. This investor's mindset helps you make decisions that create long-term value. The legacy that transcends money involves the principles you live by and the impact you have on others. Warren's greatest legacy isn't his wealth, but the principles he articulated and the culture he built. Your legacy might be the people you've mentored, the work you've created, the values you've modeled, or the problems you've helped to solve. These legacies outlast money and create meaning that extends beyond your lifetime. What you can carry forward from Warren's story involves recognizing that extraordinary success comes from ordinary principles applied consistently over time. You don't need genius or special talent. You need discipline, patience, continuous learning, and the ability to think long-term in a world obsessed with the short term. You need to understand what you're good at and focus there. You need to delay gratification and compound your advantages. You need to treat people well and maintain integrity. These principles applied in your own context can transform your life, just as they transformed Warren's.